Welcome everyone to the Klingenstein Fields webinar on the Secure Act. We're going to get started in a few minutes as people join, so please stand by. Again, thank you for joining the Klingenstein Fields webinar on the Secure Act. We'll get started in just a minute. I can see people are still joining, so please stand by. So I think we'll get started. Thank you everyone for joining us today for this webinar. Now that we've had some experience at this, I hope that everything goes smoothly again today from a technical point of view. My name is Ken Pollinger, and I am co-chairman and CEO of Klingenstein Fields Wealth Advisors. I'm delighted that you all could join us today for this call, and I hope that you find the information of value and of interest. We appreciate that many of you have continued to reach out to us to discuss the current state of the capital markets, the economy, and many other important topics about what is going on in the world today. It's rapidly changing daily. We hope that you will continue to do so. We truly believe that we are all in this together, and with each other's support, we will get through these challenging times just as we have overcome difficult times and challenging markets in the past. Today, we have James Fields, President of Klingenstein Fields Wealth Advisors, here to give you a brief update on developments since our last webinar, and Shamari Gilliard, Director of Wealth Planning at Klingenstein Fields Wealth Advisors, here to talk to us about the Secure Act and what it means for you and your families. During this call, you can submit questions one of two ways. If you're listening through your computer, there's a widget on the right where you can submit a question, or you can email them directly to Susan Curry at susan.curry@klingenstein.com. And now I'll turn it over to James. James?
Thank you, Ken. It's good to be here, at least virtually. Before I introduce Mari, or Shamari, we call him Mari, I just wanted to give a brief update on where we are since our last call. First of all, I hope everyone continues to stay safe and healthy. We are encouraged by the news that continues to come out concerning the impact of social distancing and staying at home orders, which appear to be working. The nation appears to be past its peak of the infection, and even hotspots, like where we're hosting this call from in Greater New York, are cooling. The markets are still volatile and are likely to be for some time, but we have not seen the wild swings recently that we experienced in the beginning of this crisis. As we noted in our last webinar, volatility will likely continue along with its driver, uncertainty. We may well test the lows of March 23rd, but fortunately have not yet done so. First quarter earnings reports from corporations reflect the shutdown of the economy in March. While the market had to some extent incorporated the expectations of poor data, it has still had a negative impact on the major equity averages. While there's not a definitive timeline for easing up on current policies, officials of states, particularly on both the East and West Coast, are starting to discuss what needs to happen in order to reduce restrictions. The balance of discussion now falls on the side of reopening the economy, but in a thoughtful and measured way in order to manage the inevitable increase in cases from the resumption of economic activity. This is encouraging from an economic point of view because it signals the potential resumption of some businesses, and the more testing we can do, the more promising the therapeutic options turn out to be, and the more successful the research into a vaccine appears, the faster and stronger the reanimation of the economy will be. However, As most experts have said, and we agree, it will be some time before it is business as usual, and business as usual may be very different than it has been in the past. We noted previously that we believe we will have a U-shaped, not a V-shaped recovery, and we continue to hold that view. At Klingenstein Fields, we have personally felt some of these adjustments, and technology and innovation has enabled us to conduct business without interruption, finding creative ways to meet and communicate, which has become our new normal. It is likely that many industries and companies have discovered their own effective and perhaps more cost-effective and efficient ways to carry on their operations that will endure past this current crisis. Winners and losers will emerge, as they do from every crisis. In addition, we have the engine of U.S. ingenuity rising up, as seen in a variety of companies, large and small. They are all pitching in their own way, with examples such as Ford using airbag materials to make PPE gowns, or working with 3M to make N95 masks, to fashion designers such as Ralph Lauren, Prada, Louis Vuitton, and others, temporarily retooling their factories to make personal protective equipment. This resiliency and nimbleness should help position the United States and the global economies for recovery when things do start to open up again, although we believe it will be a slow and phased approach to restarting the economy. Now I'd like to introduce Shamari Gilliard, our Director of Wealth Planning at Klingenstein Fields, who's going to take us through the Secure Act.
Thank you, James. I'm happy to be here.
Maury, we've heard a lot about the Secure Act. Can you give us a brief overview on when it was implemented and what it's about?
Sure, I'd be happy to. So we've been getting a lot of questions from clients, so this is a great opportunity to go through it. Just a reminder, as we are talking, if you have questions, don't forget to submit them through the widget if you've joined by computer, or you can email them to susan.curry@klingenstein.com. Now, everyone, including the government, likes a good acronym. The Secure Act stands for Setting Every Community Up for Retirement Enhancement, which is quite a mouthful, so Secure Act is a lot easier. This bill officially was implemented on January 1st, 2020, although some parts of it don't kick into effect until the future. The overall purpose of the bill is to make it easier to save for retirement and to make retirement plans accessible to more people. This is especially important as we are all generally living longer. As a result, the nature of retirement is changing. Many people are embarking on their second act. They're choosing to do something that they've always had an interest in, or perhaps they're working in the nonprofit world for a cause in which they've been involved with in the past. Others are continuing to work, freelance or part-time.
Thank you, Maury. That's actually very helpful. What are some of the general provisions of the bill?
Well, there's a number of parts to it, so I will review some of the core highlights for you. The first category I'm going to discuss is required minimum distributions, or RMD rules, which have now changed to allow individuals to keep their money in their retirement plans longer and continue earning on a tax-deferred basis. Previously, you were required to start receiving your RMD at age 70 and a half. The Secure Act changed that age to 72. Just a note also, while the original Secure Act dictated that if you turned 70 and a half before year-end 2019, you had to take an RMD in 2019 and 2020, or you could take 2 required minimum distributions in 2020. The CARES Act, recently passed in March in a response to COVID-19, makes the 2020 distribution optional. And for anyone turning 70 and a half in 2020 or later, you do not have to take an RMD until April 1st of the year after you turn 72. And just as before, if you are still working past the required minimum distribution age, distributions from employee retirement plans can be delayed until you retire. So another important provision is that the maximum age restriction for IRA contributions has been eliminated. So if you are still working you can continue to contribute to your traditional IRA. This allows you to continue to contribute and save in a tax-advantaged way for even longer. For this year, in conjunction with the extension of the tax filing date to July 15, 2020, through the CARES Act, you now have until July 15, 2020 to contribute for IRAs. Again, you still have to have earned income to do so. The next category is distribution requirements for inherited IRAs and 401ks, where the allowable time period has been shortened. Previously, if you inherited a non-spousal IRA or 401k account, you could take the distributions over your life expectancy. Now, with some exceptions, all funds must be distributed within 10 years. However, for any accounts that were inherited in 2019 or before, you can still take distributions based on your life expectancy. So those pre-2020 inherited IRAs have been grandfathered. For those who are senior executives or business owners, this next area may be of interest. There is now greater ability for businesses and business owners to help employees save. First, part-time employees beginning in 2024 will be eligible to participate in 401k plans. This can help you attract and retain experienced talent who may not be interested in working full-time anymore, but want to keep saving for retirement. For business owners, beginning next year, you can participate in what's called a multi-employer plan, which allows you to join with other companies to offer a single plan to your employees, while realizing the cost efficiencies of a larger plan. And depending on the size of your plan, you may be able to receive tax credit for a significant portion of the cost of starting a plan. There are a number of provisions, other provisions that I won't go into right now, but they basically regard penalty-free withdrawals upon the birth or adoption of a child. There are some 529 plan usage changes, and the ability to annuitize your 401k. I encourage anyone with specific questions on these topics to submit them or reach out to me to discuss.
Well, that's a lot of information, Maury, so thank you for those explanations. How do these changes impact planning?
Well, different provisions will impact investors differently. If you are working, you have the opportunity to continue to save on a tax-deferred basis for longer. And for non-inherited IRAs, with the change in RMD requirements, you'll be able to delay distributions and therefore taxation for another year and a half, so you will need to factor those both into your tax planning. Now, if you inherit an IRA or 401k plan, you'll be receiving taxable payouts more quickly, potentially at a higher rate than you would have been subject to later. You may want to consider taking a distribution in kind rather than liquidating securities. You'll still have to pay taxes, but there may be reasons to maintain your holdings depending on your need for the funds and market situation. So if you do take a distribution in kind, the value of your securities at the time of distribution becomes your new tax basis, and transfer date is considered the date they were bought for your account for capital gains tax purposes. There are many nuances to these changes, so again, I encourage you to reach out to us for a more in-depth discussion regarding any questions that you may have.
Thank you, Maury. That was great information, which I'm certain everyone on the call will have found useful. We will continue to provide information and insights on the Secure Act, the CARES Act, and the general alphabet soup of other government actions being taken. This week alone, there was passed an additional $484 billion financial package in Congress supporting small businesses and hospitals. At this time, I'd like to open up the call to questions. Again, if you are listening through a computer, you can submit questions to the widget on the right side of your screen. Or you can email any questions to Susan Curry at Susan, S-U-S-A-N, .Curry, C-U-R-R-Y, at Klingenstein, K-L-I-N-G-E-N-S-T-E-I-N.com.
Great, thanks. Well, we have a number of questions. I'm going to start asking them, and I'll let the panelists know who's going to be answering them. First question is for Ken, and it's a two-part question. We had a number of people asking just generally in terms of Klingenstein Fields, whether everyone is still well, healthy, et cetera. And in light of what James said about governors and legislators meeting to talk about eventually reopening up economies and states, what is Klingenstein Fields' plan in terms of that?
Well, thank you. Thank you. That's a great question and important question, certainly for all the folks at Klingenstein Fields. I've personally reached out and spoken to everyone at the firm, and thankfully we're all safe and healthy. Everyone seems to be coping with working from home fairly well, but the coronavirus has touched all of us in some way. We all know someone who's been affected, whether it's a relative or a friend. We all have family members, or many of us have family members who are doctors, nurses, EMTs, and other first responders, putting their lives at risk every day for all of us. And we all know people who have lost their jobs or been furloughed or at risk of losing their jobs. I have friends and relatives myself that have recently lost their jobs. It's a very stressful and emotional period, especially for the elderly, worried about whether they're going to get the virus, if they're going to survive the virus, the impact on their families and their loved ones. But us at Klingenstein Fields, we're fortunate in a way because we're all able to work from home, from the safety of our own homes. We have great technology that allows us to meet our clients' needs and manage the portfolios. We're able to assemble our investment committee remotely as if we were in the office. We've not missed a beat with our regular meetings of financial planning, compliance, asset allocation, and all the various meetings that we have weekly and regularly. What we do miss, though, is the day-to-day human interaction, the ad hoc meetings that take place spontaneously in the hallway or in the kitchen or the impromptu meetings in your office. We have a very collegial atmosphere in the office. We have a collaborative culture that cannot be duplicated on Zoom and or Slack, but we all look forward to getting back to the office. We all miss each other. We like seeing each other's faces on Zoom, but it's not the same. But we're all safe and healthy, and thanks for asking that question. The second part to your question, we've been taking our guidance from Governor Cuomo. You may have seen that yesterday he extended the school and essential services closing until May 15th, so we've been following his guidelines. We are a financial services company, so technically we are an essential service, so we can and we could have been in the office this entire time, but we've chosen to take the cautious approach. Our primary objective is the safety of our employees, to make sure they're all safe and healthy. We all take mass transit in some form in the New York City area, whether it's trains, buses, subways, or just walking the crowded sidewalks in New York City. So we plan to return to the office when it's safe, to do so, to ensure that all our employees are well and can return safely. Thanks for asking that question. It's very good.
Great. Thanks, Ken. Next question is for Mari. You mentioned 529 funds and some changes from the Secure Act. Could you talk a little bit more about that?
Sure. Good question. So as far as 529 plans, they're tax advantage accounts that are used to pay for educational expenses, which many people know. The Secure Act basically granted owners increased flexibility in terms of use of funds on behalf of the beneficiary. So in addition to the typical use around tax-free withdrawals for qualified education costs, you can now have distributions of up to $10,000 to repay student loans over the course of the student's lifetime. On top of that, you can have $10,000 each come out of 529 for the beneficiary siblings to, again, be used to repay student loans. In addition, there is certain changes in the classification of certain apprenticeships programs, which are now designated now as qualified education expenses. So all of these are great in that they're giving people more options and flexibility and use of these funds.
Great, thanks, Mari. Next one is for James, and it's pretty specific. It's about purchasing distressed debt or preferred dividend yielding stock of otherwise strong companies. What is Klingenstein Fields' position on that in this environment?
Great, and thank you for the question. I'm going to go step back one level first. And at Klingenstein Fields, as you likely know, this audience, we do our own research. We have our research team, which was expanded even greatly last year, and it is a team of highly seasoned professionals that analyze both companies and the securities of those companies, as well as managers of different asset classes. When it comes to looking at distressed debt or preferred stock, higher yielding products or issuances of otherwise strong companies, we're constantly looking for those opportunities. When we think about how we structure portfolios for clients, we first are interested in the goals and objectives for the pool of assets that we're managing. We then think about what's the right asset allocation. And then within the asset allocation, we're looking to either purchase securities for each part of the asset allocation or work with other managers that will do their own research to purchase those securities. So when it comes to distressed debt in general, we do have partnerships with a number of distressed debt specialists that we work with. When it comes to specific securities that may be baby with the bathwater, good companies or good securities that were thrown out or trading at, we think, less than intrinsic value levels, we are certainly looking at those. But each purchase has to make sense within the long-term plan for that client and within the asset class for which we are allocating those funds. So for example, when you think about distressed debt or preferred stock, that tends to fall into the fixed income portion of the asset allocation. And for that, we want to step back and say, what is the purpose of that part of the asset allocation? What are the goals and objectives within the larger portfolio construction? So the short answer specific to the question is yes, we are looking at those. The companies that we cover and the managers we work with do a company by company and security by security analysis. And in some cases, it can make sense and has made sense to allocate to distressed debt or to other types of non-traditional equity securities within companies that we cover and follow. I hope that was helpful.
Great, very helpful. Thanks, James. Next one that came in is for Mari. I understand the option not to take RMD does not apply to defined benefit plans. Is that correct?
That is a good question. I would say I know that all plans, including defined benefit plans, are subject to required minimum distribution rules. Knowing that the Secure Act pushed back the application of this particular R&D age from 70 and a half to 72, it would be relevant in my view. But that's something that I would say we have to look into a little bit further.
Great question. We will definitely look into that and we will get back to everyone on this question. Thanks so much. Next question is kind of, they're similar questions. A few of them came in. One, charted parallels with the Great Depression, showing a market drop and a brief resurgence, followed by additional drops. Is that where we are, and how is Klingenstein Fields planning for that? So there are a few different questions about if the market really is going to go down further. What is Klingenstein Fields' position, and how are you planning for that?
Thank you, Ellen. That's a great question. This is James Fields. I'll take a stab at this one, and certainly my colleagues are more than welcome to augment what I respond with. I think There are a number of parallels that have been made recently. There's the Great Depression, specific to the question. There's the Great Recession of 2008-9. There's what happened post 9/11. These are all in some ways relevant and in some ways different. This was, and there was a good description in one of the recent articles, a self-induced economic coma. The real economy globally and the financial markets, particularly in the United States, were very strong coming into this period. And what we've seen now, which didn't exist back in 1929 and in the 30s, in fact, some of the things that are benefiting us today in terms of the government response came out of what happened in the Great Depression, is the amount of government reaction and the fact that much of the demand destruction we're seeing today is self-induced. There's every reason to believe that the combination of pent-up demand and unprecedented fiscal and monetary response to what's happened is such that we won't have a repeat of the glimmers of hope and the move up in the markets, and then another leg down that's much more severe. The other example that's been given frequently is the 1918 pandemic for influenza, the Spanish flu, which, as you know, had 3 waves of infections. Now, again, we have the advantage of knowing that. We have the further advantage of great leaps in science. There's a number of therapeutic options being worked on right now. There's a number of vaccines being worked on right now. I think what will be driving the answer to this question is, as we open up the economy, do we do it in such a prudent fashion such that the increase in infections, which will happen, by definition, it will happen, as those increases in infection rate increase, do they increase at a rate that our hospital systems can manage? And as long as we keep it below maxing out the healthcare system, there's every reason to believe that we won't have that next leg down. We certainly believe still, as we mentioned in our last webinar, from a technical point of view, there's every reason to believe that the financial markets will retest their lows of March 23rd. We haven't seen that yet. You can see that the bias of the markets is to the upside whenever there's good news. And part of that comes from the fact that the folks in Washington, particularly the Federal Reserve, have made clear that they will do whatever it takes to support both liquidity in the financial markets and then through fiscal policy, at least the solvency of employees, if not all employers. I don't know, Ken, if you have something you'd like to add.
Yeah, thanks, James. I would underscore, two important points that James made, and it can't be understated. The response from the government, from a monetary point of view, particularly the Federal Reserve, and also from the Congress from a fiscal point of view. Unlike the Depression, the governmental authorities acted swiftly and decisively, and they responded with a massive response. The Fed has a role and responsibility to provide as much relief and stability as they can during this period of uncertainty, and they've indicated that they're going to do that. They slashed interest rates to between 0 and 0.25%, and they signaled that interest rates will remain low for a long period of time. This is very important to encourage lending and to get the economy back on its feet. They vastly increased their lending facility to the U.S. government market. This is really important. Unlike 2008, 2009, when it looked like the financial markets were seizing up, here the Fed has responded in a way to give confidence to the markets that they're going to continue to function properly. And that's really important because credit flows through our capital markets, and it's essential that they remain functioning. So the Fed is doing their job. They're doing an incredible job. They've indicated they're going to do whatever it takes to keep the market, the economy functioning, and to limit the damage to the economy. This is very important. And the second point that James alluded to also is the response from the politicians on the fiscal side. They acted swiftly. They did things like extend the tax deadline to July 15th. They passed the CARES Act, which provides assistance to American workers and families, to small businesses, to local governments and state governments. They made direct payments to individual Americans. They've created aid for hospitals and extended unemployment benefits. These are very important responses that I don't believe we had during the Great Depression, so I'm not sure the parallels are the same, but this provides an incredible amount of liquidity to the system, to the economy, and I think it will help smooth out any steep declines we have in the market or the economy.
Great, thanks, James. Thanks, Ken. That was a great response. Next couple of questions are going to be for Mari. First one, you mentioned some parts of the CARES Act that affected the Secure Act. Are there other parts of the CARES Act, I'm going to be acronym heavy right now, that also affect other parts of the Secure Act? Great question. That's for Mari.
Yes, great. Thank you. The answer is yes. So I would say a provision that a lot of people are talking about in terms of the CARE Act is one that allows individuals in 2020 to withdraw $100,000 from their IRA if they're under 59.5 and they've been impacted by COVID-19. So this individual would still have to pay tax, but they could spread out the liabilities over a few years. If they were to recontribute the amount that they took out, they would be able to do so over the next 3 years as well. Again, a point of emphasis is that to take this hardship withdrawal, as it's called, you would have to be impacted by COVID. And what does that mean? That's defined as you, your spouse, or your child diagnosed. Alternatively, it could be financial consequences that have negatively impacted you. And that's, getting laid off or furloughed or having your hours reduced. On top of that, individuals impacted who are working with a 401k could also take a loan of up to $100,000 from their plan. So these options should be an emergency source of capital, but it's helpful for folks who need a short-term bridge.
Great. Thanks, Mari. A couple of questions that a few people asked about charitable donations and distributions. I'm going to group those together. One is, can I still make charitable donations from my IRA at age 70.5, or do I have to wait till age 72? And together with that, does the change in the required minimum distribution age affect the allowable $100,000 annual qualified charitable distribution from IRAs? That's for you again, Mari.
Okay.
Hitting you hard.
Great. Good questions. So as far as qualified charitable distributions, they are good. You can still make them. They are going to continue. These strategies are really great because they allow IRA owners to make a direct distribution to charity for up to the $100,000 that you mentioned. When they do so, they satisfy their RMD, and they don't have to recognize those same funds for income tax purposes. Now, we have a year, as I had touched on before, where people have the ability to suspend 2020 required minimum distribution. So I imagine less people may take advantage of this particular strategy this year, but it's definitely something that's great because it allows someone to reduce income recognition and to provide proceeds to a charity. Now, as far as the age is concerned, it is still 70.5. And a lot of people were thinking, okay, well, maybe it's because they forgot, but I think it's actually because, they still lawmakers don't want to disincentivize people from making contributions. Now, even though it's 70.5 and your RMD age is now 72, you can make a qualified charitable distribution that funnels money directly from your IRA to charity. But again, it's not going to count toward your RMD. until you're actually forced to make that required minimum distribution. So you can still reduce, it still won't count as income in terms of your AGI, but it's not going to check the RMD box because if you're 70.5, technically you don't have to check that box just yet.
Okay, great, thanks. One question for James from a listener, maybe a little bit premature, but interested in thoughts of the effect of the pandemic on international and particularly emerging market equity investments going forward.
Sure, that's a great question, which we appreciate because we do think of ourselves as global investors. It's very interesting, the way that this virus has evolved. It's been a northern hemisphere phenomenon so far. Some of that's because we believe that it acts seasonally, much like other coronaviruses and like influenza. Much of the emerging markets are in the southern hemisphere, so I think it's premature to have a point of view on how this virus, from an epidemiological point of view, will impact developing nations. And while there is some reason to believe that, for example, there were thoughts that chloroquine, which is an anti-malarial drug, had provided some sort of herd immunity in countries that have suffered from malaria historically, for example, in Africa, it's still way too early to tell. There's also reason to believe that the virus doesn't do as well in warm, humid climates. Again, I think we don't yet know enough. So I think the risk reward, without being emerging market specialists in emerging markets, is probably tilted toward risk at the moment. And I think it would be, for most of our clients, probably premature. Other international markets, though, are quite different. And when we think about investing, we think about great companies, leading companies in their industries. We think much less about where they're domiciled. And I think if you look through a typical portfolio for our clients, many of those industries, many of those businesses are headquartered not in the US, and certainly most of them are global and sell globally. I do think, not just around investing internationally, I do think as we talk about, quote, new normal, one of the big impacts of the virus and the governmental response to the virus in terms of closures and deglobalization, you might say, is that supply chains, which had become very global, actually starting in the late 80s with the Japanification of things through just-in-time delivery, etc. That will likely now, pendulum will swing the other way, and we will now see more insourcing, not just in the United States, but most major economic blocks, United States, Europe, the ASEAN nations in Southeast Asia, will likely want to insource more of their critical supply chains. And that will create interesting opportunities, but may also have some impacts in terms of decrease in trade, which has generally speaking been helps developing markets, at the same time allowing those developing markets to focus more on building their own economies, and arguably the next time we face such a global crisis, make each of these different blocks stronger.
Great, thanks, James. I think we have time for a couple more questions. One is Mari, and this came in from a listener. I'm not sure he or she has age limits listed. I'm not sure what they mean. It says, as long as you're within the age limits, there aren't any limitation on the time you have to adopt changes in your retirement plans. And I think what they probably mean, as long as you're not 72 yet, do you have, is there a stage in or a phase in and when you can do these things?
Okay, so I think before I answer that, I want to go back to the last question quickly that you answered. So in terms of defined benefit plans, while I was waiting for the next question, I just looked it up myself just to make sure. So the answer as far as RMD waivers is no. Defined benefit plans are not included. So if you were supposed to take a distribution from the defined benefit plan, you have to continue to do so. In terms of the question that you just asked, I think what they're saying, and correct me if I'm wrong, Ellen, is that I had said if you were 70 and a half in 2009, if you turned 70 and a half in 2019, then you had to take a required minimum distribution in 2020, but obviously the 2020 distributions were waived. So if you are waiting for that age 72, is there something else you can do? Is that basically what you're saying?
I think that's probably what they meant, yes.
Okay. No, I don't think so. As far as if we're talking about obviously an IRA, a plan where it's outside of your core 401k plan, if you're still working, you're going to have to take the distributions after 72. If it's something where you have a 401k and you're still working, you can delay. Now, there is a way to have a reverse roll-in and basically take IRAs and roll them into 401ks in certain instances, but it's really up to the plan administrator and how exactly that works, because that's not the case with all plans out there.
Great, thanks, Maury. So I think we have time for one more question. I'm going to put this last question that we got first to you, Maury, and then James and Ken chime in, add in your perspective. So really, it's a more general question. Are there any planning or tax or investment changes people can do now, should be thinking of in terms of the current environment, the changes in Secure and CARES, et cetera, and what's going on and what Klingenstein Fields sees ahead? So kind of a general broad question, Maury first, then to Ken and to James.
Okay, great question. So I will give my take, and I have a couple answers on that. One, if you have an IRA, you may want to reevaluate your plan for those funds in terms of beneficiary designation, estate plan, and if it still makes sense for you and your heirs. I'd say second, there's a lot of clients these days who, they'll talk about Fed funds rates, and there's a lot of them out there who are potentially refinancing mortgages in the current environment, which is very beneficial. What really is not getting talked about enough, in my opinion, is the historically low and favorable IRS applicable federal rates set for things like gifting and certain trust strategies and interfamily loans. Just to give you an example, with an interfamily loan, a parent could essentially act as the bank, lending to children at a minimum rate the IRS requires to make the transaction valid. So right now, for instance, if you had a short-term loan, which is defined as up to a 3-year term, that would be 0.25%, a quarter of a point that you could lend money to a child using. And for a loan that is long-term, that's over 9 years, the IRS would only require that 1.15% of interest would be charged. So this would be a formal agreement. This would be, classified as an actual loan and not a gift. I would say lastly that, just gift giving in general in a depressed market is always smart, because it allows you to pass assets or cash to the recipient, which will be invested and likely rebound in the coming years, making the current environment perfect for wealth transfer.
Yeah, thanks, Maury. This is Ken. I would just add, a couple of points, some of which you already touched on. This is a good chance to, and I've got a little experience at this myself, to update wills and healthcare proxies, but especially for those of you that may have aging parents, it's a good time to make sure, check in with them that their estate planning documents are up to date and you know where they are. If you have unrealized or gains or losses away from us, or realized gains or losses away from us, it'd be good to let us know so we can help manage your portfolios that we do for you more optimally. And I know some of you I've spoken to about, change in lifestyle or change in, where you live. It's probably a good time, or might be a good time to think about, real estate purchase. If you probably not a good time to sell, but certainly for those of you thinking of a second home or a change in lifestyle, now might be a good time to think about it. We take a long-term approach in our investments, and we've gone through every investment cycle, every economic cycle, and we think we're going to get through this cycle as well. And James, I don't know if you had anything to add.
I'll just add a broader point. I think you guys have well covered planning related. For all of our clients, we construct long-term plans. We are long-term investors, and that doesn't mean we have not been and won't continue to be opportunistic with the historic dislocations we've had in the real economy and the associated changes in the markets and increased volatility. But we believe that in, if not all cases, the vast majority, those plans have proven to be quite resilient in the volatility we've seen. We have not had scenarios where asset allocation was not appropriate such that we were forced to sell securities at inopportune times. So I think as we think more broadly about asset allocation and portfolio construction, we want to continue to check in with all of you as we do on what the goals and objectives for the assets that you entrust to us are, and that asset allocation reflects that properly. That allows you to, even if the markets do retest those lows, as we think they may, or go down again, that you're not forced into a scenario to make decisions you wouldn't otherwise want to make. So even though it's very emotional and stressful time, if these portfolios are constructed properly, as we believe they have been when we made these plans at non-stressful and non-emotional times, that's the reason to do that, and we've continued to weather that. I know this is our last answer to our last question. We appreciate everyone. I know, Ken, you'll have some closing remarks. Just want to remind everyone, we will get back to folks who had questions that were not answered on this call. And of course, we're always available, not just the three of us, but the rest of our other 40 colleagues to take your questions at any time.
Thank you, James, and thank you, Maury. And I also want to thank everyone for attending this webinar. We appreciate it very much and hope you found it interesting and helpful and informative. Again, please reach out to your advisor or anyone at Klingenstein Fields Wealth Advisors with any questions or concerns you may have, and we will continue to communicate with you frequently as we have and keep you up to date on our perspectives. And we hope that you all stay well, stay safe, and we look forward to speaking with you again soon. Thanks again.
Thanks, everyone.